welcome to the Mutual Fund Show. The next 20 minutes, we'll talk about two key aspects of mutual funds. In fact, we'll talk about the two main aspects about mutual fund investing is to how to go about investing in equity funds and how to go about investing in debt funds. But we'll relate it to what's currently happening. Maybe it helps to be a bit proactive and try and understand what the impact on your schemes could be if you're parked in the wrong schemes. Now, because the world is changing at a hectic pace, interest rates, equity valuation, so on and so forth, maybe it helps to try and understand whether your portfolio should have some minor or major changes or not. To try and do that, we'll keep it simple today. We've gotten two guests with us, Mohit Gan and Nikhil Kothari of Moneyfront and Etika Wealth, respectively, and they join us to tell us what is it that they are doing to their own portfolios and telling their clients to do. Gentlemen, both of you, thank you so much for joining in. Mohit, I'll start off with you and start off with equities first thing. Um, if there is a viewer who's come on the show today and she's not comfortable putting in lump sum money to invest into mutual funds because she fears that, or she is of the belief that there is a bit of a period of uncertainty ahead, but still wants to invest that money, what is it that she should do? What is it that you would advise her to do?
Right. Hi, Neeraj. Always a pleasure to be on your show. Look, I think
Thank you.
obviously it's a known thing that markets have been a bit volatile of late, and relatively India has done exceptionally well. The U.S. markets, or let's say Nasdaq, for year till date has been down almost 29 odd percent. Sensex is up 4%, right? So the dichotomy is huge, and I can very well understand that investors are skeptical. They are sitting on the borderlines, they're wanting to invest, but they are also wary that yes, globally the markets are correcting, interest rates are on the boil, oil is on the boil, commodities are rising, so on and so forth, but the Indian equities are not relenting in this scenario. And look, honestly, appreciating the fact that we are extremely overvalued also, our suggestion to clients right now is to stagger your equity allocations, not jump in with lump sum. Uh, Honestly, I think there's no point being a cowboy in this market. To be very honest, I think the relative outperformance is stood for almost 1.5 years, and it is perhaps likely that we might just relent under the tremendous global pressure, basically. So STP or an SIP approach, staggering out across next 9 to 12 months, could be the first best approach. A second thing on the equity front to all our clients is to be a little safe in the cocoon of large caps or flexi caps at best. Basically, I think that's a more safe zone right now. If you want to increase your allocations currently to equity, go towards this side. The third point, in the same breath, is that if you really want to get into equities, then also considering hybrid allocations right now, which could be a balanced advantage fund or a multi-asset fund, can be a great strategy. It gives you the best of both worlds, or perhaps in case of multi-asset, the best of multiple worlds, including commodities and some bit of REITs and InvITs and other things also. So kind of gives you an automatic hedge, kind of does the balancing or the asset allocation approach also quite automatically. So I think that's something which each of the clients should do right now if they are actually wanting to invest into equities.
Hmm. Well, just a follow up. If somebody's has a time horizon of 4 or 5 years, because we've heard it a number of times on the show, that if you have a very long time horizon, then India still offers a really great opportunity in the broader end of the spectrum. So should that person also take the relative safety of the large caps, or is it better to do a staggered investment in, say, a mid cap or small cap funds?
Look, Neeraj, I understand that yes, it's a long-term story. Perhaps all markets are good in long term, right? I can't fault US markets for that matter, and even Indian markets for that matter. If you're investing for 20 years, yes, you can take a slightly more aggressive stance on the market. But to be very honest, I think we are all investors at the end of the day, and we would like our capital to work in our favor at all points in time. I would still suggest that given the way the markets are stacked up today, I would actually prefer a large cap or a flexi cap approach. The reason why I've included flexi cap is because to me they work like a pseudo large cap, but they will still have some 10, 15, 20 odd percent of mid cap allocation and maybe a very minuscule composition of small caps. So they give you that dynamic flavor also across your portfolio.
Hmm.
But yes, I would rather go with that approach right now in the current context.
Okay. Okay. Let's try and talk some funds. Mohit, so on the equity side, we are still talking equities. Mohit, um, fill us in on what are some of the better funds in each of the categories that you advise. Viewers, remember the list need not be exhaustive. These need not be the only ideas that our experts would recommend to their clients, but this is used as some illustration um, for the conversations that we're having. Mohit, all yours.
Perfect. So yeah, Neeraj, this is not the entire list, but yeah, few of our picks would be, let's say in the large cap front, we prefer passive index fund. So out there, my choice is through ICICI Nifty Index Fund. On the flexi cap front, we can go with Aditya Birla Sun Life Flexi Cap, even UTI Flexi Cap for that matter. On the balance advantage side, Tata Balance Advantage and Edelweiss Balance Advantage are two of our picks. And on the multi-asset fund, through ICICI multi-asset, Tata multi-asset, even Nippon multi-asset to some extent. I think those are our picks in each category.
Interesting that the Tata mutual funds are finding presence place in your portfolios, Mohit. Especially in the balance advantage fund category, is the first time I'm seeing somebody recommend these. Why so?
Look, I think the hot favorite in the market has always been True ICICI Balance Advantage. I absolutely like that fund, basically. But I think Edelweiss and Tata offer something different. Plus, the AUMs are still quite respectable in this segment. True ICICI is almost touching 40,000 odd crores as an AUM. It's a great fund, very neatly managed, and we still continue to have large holdings out there. But as an added new allocations, if you really want to consider two different themes, and I really like the way Edelweiss and Tata are working on that front.
Got it. Okay. Now we should focus to debt, because debt too has had various variables impacting it in the last 12 months. I mean, quite a news heavy year for somebody who's wanting to invest in debt. And I know different tenors have different kinds of funds, but for argument's sake, let's keep it simple. For somebody who wants to invest for a period of about 12 months, and for somebody who wants to invest just slightly over 3 years to take advantage of the taxation. So, what is it that this person can do? And Mohit, how are you approaching this? What are you telling your clients on the debt side?
Look, Neeraj, I think on the debt front, there are two kinds of clients. One who believe debt as debt and they absolutely want safety and conservation of capital, and they are absolutely not okay with any kind of risk, even be the interest rate risk in the short term, right? So for people who don't prefer to have any volatility but just want consistent, even low returns are fine, then we are asking them strictly to remain at the short end of the curve and stick to ultra short term or money market funds, because that's where the volatility will be absolutely less, and they will give you a fair deal of around 6ish odd percent kind of a return, which is roughly the YTM in that range currently for those kind of funds, right? And
This
you
is for a particular time frame, Mohit. Sorry, I'm interrupting you.
any time frame from, let's say, 1 month to around a year,
Okay.
kind of a parking. And even though if you want to go ahead, let's say 1.5 2 years, it won't harm you, though. Yes, or at that tenor you can perhaps try and increase your yield by getting into other instruments. But yes, this is absolutely fine for anyone who wants to invest beyond a month or 2 months kind of a period. Right, so that's on the short end. But if people who are okay with some amount of interest rate volatility in the portfolio, because our opinion is that the interest rates will further go up, the yields are likely to harden further up, basically, and you might see some amount of volatility and some amount of what do you say, interest rate markdown in your portfolio related to that, right? So if you are really okay with that, then I think what Nikhil said makes absolute amount of sense, to go into target maturity funds. You align your investment horizon with the kind of tenor the funds are offering, and there are target maturity funds across the spectrum these days, right from 2025 up till 2032-33 maturity. You will find a scheme or multiple options for each year, right? So if you really want to go for 5-7 years, go ahead. You will get the indexation benefit. Tax will become highly efficient, and the paper quality is absolutely clear. These are highest rated papers. You will have all AAA, PSU, SDL kind of portfolios, and the yields are very, very attractive right now, Neeraj. The yields in all these portfolios is somewhere in the range of around 725 to 750, 775 even for 2030 kind of maturities, right? So it's a great option, but there will be some volatility next 1 year. People have to be cognizant of that. It won't be a straight line.
Okay. Okay. Now, Mohit, come in with the names of the funds. What are, I mean, for example, if they are taking target maturity funds, what are the options there? And from a short end perspective, would most products be homogeneous, or there are one or two which examples that you can give?
Look, on the short end, Neeraj, if you're looking for April, specifically or March maturity 2023, I would rather go with a DSP savings for a March maturing portfolio and April 23, Edelweiss Bharat Bond, April 23 paper. These are on the short end. On the money market side, I can go with Aditya Birla Sun Life Savings Fund or Approve ICICI Money Market Fund. And on the ultra short term, you can pick up, actually, there's not much of a difference, but yeah, ICICI Ultra Short Term or an Axis Ultra Short Term is a good option. On the roll down of the target maturity funds, there are plethora of options. Honestly, the names are extremely confusing for investors to remember, but I would rather go with few thumb rules out there. Look, Edelweiss Bharat Bond has been the most successful target maturity series ever done in this country, and they were the pioneers actually to start this trend in the world of debt mutual funds, right? So anything from 2027 to 32, I think, or 28 to 32, you have Edelweiss Bharat Bond series available for all the maturity years. They are the highest quality papers with the lowest expense ratios in the market, which is extremely important when you invest in a debt fund. So I would suggest that anyone looking for a for between options, then you have many CRISIL, SDL, PSU paper combinations, CPSE paper combinations. These are all written down in the nomenclatures of the scheme, so you can go ahead and pick it because these are finally all indices, and the funds are just mirroring the index, right? So they are fairly safe, and the paper quality is high, so you can choose either of them.
Okay. Um, uh, Gentlemen, I heard a term over the last 2 days. I mean, so what should people do if they have existing investments in constant maturity funds? These would be homogeneous or similar to target maturity funds, Mohit?
Not exactly, Neeraj. The constant maturity is a different category by SEBI, and they are mostly 10-year gilts actually in the portfolio. So the category is called 10-year constant maturity fund, right? So out there, the portfolio is fairly long dated, which is exactly 10-year kind of a maturity, exact as in the nearing 10-year maturity portfolio. So the interest rate sensitivity is fairly high in the portfolio. But if people are holding, look, you're almost nearing the peak of the interest rate cycle, if not there, right? So you are at around 720, 730 on the 10-year yield, perhaps at 8%. Yes, I would say that, okay, just start entering in at the longest end of the curve, whenever or wherever you can get opportunity. You are not there, you will see some good markdown impact on your portfolios as you move towards that range, and you will certainly move towards that level, basically. So there will be some volatility. However, the accrual yield on the portfolio will be fairly high, should be somewhere in the range of around 750, 775 for that kind of a maturity. So that's okay to hold right now. For people who are waiting for that level, anything upwards of 775 on the 10-year, I would say start getting into the long end of the curve. So it could be a 10-year constant maturity, or even a fund like a Nippon Nivesh fund, which have papers like 2042, 2043 maturity. So it's a 20-year kind of a portfolio. It's a fantastic portfolio for someone who really wants to build a long-term debt portfolio. You want to build a long-term 20-year debt portfolio, go with that fund. It's a great fund to be in, and just ride the interest rate cycles as they come along the way.
Okay, Jamin, thank you so much for giving us this time and telling us both on the equity side and the debt side. And I'm sure these answers are very, very helpful to a bunch of people who are thinking of investing currently via the mutual fund route. So I really appreciate your time, both of you.
Thank you. Pleasure, Neeraj. Thank you.
Yeah, and the pleasure was entirely ours. And viewers, thanks for tuning in to yet another very informative episode of the Mutual Fund Show.